Alright, hey guys, welcome to video 2. In here we'll be talking about fair value gaps and what are they, as well as disrespected fair value gaps called inverse fair value gaps. So, what are fair value gaps? Fair value gaps are imbalances in price, or like gaps in price, where price needs to fill later on. So, how do you identify them? Well, let's take a look right here. A fair value gap is a concept that is made from 3 consecutive candles, such as this one. Let's take a look. 1, 2, 3. Right. Let's just take a look at these 3 right here. Now, a fair value gap is created when there's a gap in price, right? Now, in the previous video, we learned about candles and like their bodies and wicks. Well, a fair value gap is created when the middle candle between the 3 consecutive candles do not have overlapping wicks. Now, what do I mean by this? Well, let's take a look at, let's say, these 3, right? You see that this candle here has a wick, a high right here, and this candle has a wick, low right here, right? Now, you can kind of see that from, if you were to measure from this wick to this wick, we sort of have a gap in this body of this middle candle, right? If you see these 3 candles, we have like a little gap from the top of the wick right here and the bottom of this wick right here. This right here is what we would label as a fair value gap. Why? Because price in this minute bursted out and create a gap where orders were not able to be filled because price moved too fast. And the candles before and after were not able to meet any of these prices in this 3-minute time, in this 15-minute time zone as we're on the 5-minute. Right. So as you can see, this is a gap, and if you were to extend it, price, went away with this algorithm and came back and filled this fair value gap. Now let's take a look at a bearish fair value gap. That was a bullish because this is made of bullish candles or green candles, right? Let's take a look at a bearish fair value gap right here, right? We can see right here that this is a huge candle, right? If we were to look at these 3 consecutive candles, we can see that the wick of here, of this first candle, and the wick of the third candle do not overlap one another, right? These don't overlap one another. You might ask, oh, but there's no wick here, so we can't measure it. Well, that's not true. If there is no wick present, you would put it at the top of the candle. Or if there were no wicks up here, you put it at the low of the body of the candle. However, if there's a wick, you would put it at the wick, because we need the lowest point and the highest point. As you can see here, this is a gap that price would need to fill later on. If we were to extend this, right, if we extend this bearish fair value gap, we would see that price had, came up and down, create a market, but came back to this huge fair value gap and filled it in, right? Now, why is this important? Because this is a confluence that we can use for trading, because we know that gaps in markets need to be filled, and it's a confluence because we know that some fair value gaps are reactive. Let's take a look at what I mean. So we see 3 consecutive candles, right? Let's take a look at these 3. Let's look at 1, 2, and 3, right? Now, once again, if it's a bearish fair value gap, we take it from the wicks of the lowest point of the first candle and the wick of the highs, which in this case, there is no wick. So what do? We would put it at the first body of the candle. As you can see, when we drag it along, create the fair value gap, you can see that price came down, came back up, filled the gap in this price, and then went to head lower, right? Let's take another look at a bullish fair value gap, right? So let's see, take this example. Now in this case, if we were to look at these 3 consecutive candles, you can see that we have 2 green candles and a white bearish candle. It does not matter, as it could be a bearish, bullish, bullish, or bearish, bullish, bearish, or all bullish. As long as there is space between the body of the candles from the wicks, right? So if we were to take a look at these 3 candles, you would see that we would take it from the high to the low, because this is a bullish fair value gap. Why is it bullish? Because we are currently price moved up, and the fair value gap is created from a bullish candle, right? So if we were to drag it along, click a fair value gap, we'd see that price created this fair value gap, came up a bit, came back down to fill this gap or imbalance in price, and became higher. Now, if you use context clues, you would understand that a bullish fair value gap, price would come higher, right? If it was a bearish fair value gap, price would react to it and head lower, right? Now, how do we know what fair value gaps are effective, right? Because as you can see here, we have multiple fair value gaps, right? Let's take a look. Let's say we have a fair value gap right here, right? These 3 consecutive candles. But then we also have 3 consecutive candles here, right? Another 3 consecutive candles. As you can see, this one's a lot smaller, but the wicks do not overlap. And we see that we have this other fair value gap here. Now, you're like, okay, there's so many fair value gaps. Which one are we supposed to know what to enter off of? Well, when you're looking for something to buy, right, you want to buy something that's at a low price, right? It's what we call a discount. And we want to sell something, right, at a higher price, which we call a premium in this case. If we are looking to sell the market, right, we would have to look for a fair value gap that is in premiums, right? Because we want to sell here and then buy back lower, right? We want the most amount of profit. Same with the banks. The banks want to sell at a higher price and then buy it off at a lower price, right? So if we were to look here and we were to drag all these fair value gaps over, all of these, right? We would see that price reacted off of the most fair value gap in premium, right? This is the highest fair value gap, right? That we see with the huge move, right? And you see here, this fair value gap is at the middle point of this. If you were to take a look from the swing high to swing low, this is at the middle point, which is why it was disrespected later on. But see how this top bearish fair value gap, right? Because if it's bearish, we want to buy up top. If we're bullish, we want to buy the bottom 50, right? So as we see here, this fair value gap is at the highest point, which is why, as you can see, price reacted every time in this fair value gap, right? So keep in mind that these, although they're fair value gaps, they're not as powerful and as efficient, because people don't want to, right? If they're to sell, people don't want to enter at a price where it's near the middle point. They want to enter above the 50, because that would give them the most amount of profit, right? So as you can see here, this fair value gap would be the one that we would focus on, right? Because it's at the highest point. As you can see, price came up, reacted, price came up, reacted, price came up, reacted, price came up, reacted, and then it fully dumped, right? But all imbalances need to be filled, right? Which is why, as you can see here, why did price come up here? Well, if we were to take a zoom in, we have a tiny imbalance in price right here, right? This tiny fair value gap, which is the only fair value gap up here, which is the highest, right? And see how price came all the way up here and decided to fall all the way down. Now, this applies to a bullish fair value gap, right? If we take a look at a bullish fair value gap, let's take a look at here, right? Let's see. We have one right here, right? If we were to take a look at here, we can see if we're looking to buy, right? We would see there's a fair value gap right here and a fair value gap right here. Now, why would we not enter, right? Why would this fair value gap be disrespected, right? Disrespected means that the candle went past this fair value gap, right? And see how price reacted off of this fair value gap and went higher, right? If you were to enter a trade off this first fair value gap, you would have lost your money and get stopped out here, right? Because this fair value gap is lower than the previous. And as you know, when we're buying, we want to buy low and sell high, right? So if we were to mark out our charts, we would only list this fair value gap here because it's lower and it is at like the 50% mark and lower, which means that this is more effective and more powerful. Now, what happens if a fair value gap gets disrespected? Like saying how, like usually a fair value gap, the wicks and the body should close inside the fair value gap, but if the body were to close above, then it would be disrespected, right? So like this would be respected fair value gap because a body candle never closed inside above this gap, right? Well, let's take a look at what's called an inverse fair value gap, right? This is a prime example of an inverse fair value gap. Right, we look at this bearish fair value gap and we draw a wick to wick, right? Wick to wick. If we were dragging along, we can see that this candle here came up and filled this fair value gap, right? Problem is, see how the candle closure is above this gap and not below, right? If it was bearish, we want candles to close below, right? Because we want to see lower. But see how this candle, right? This candle right here, the body closed above it. This means that this fair value gap has been disrespected. Now, what does it become? It's become what's called an inverse fair value gap, right? Now, why is this important? It's important because when a fair value gap is disrespected, that means that we want to see higher, right? If bearish confluences are being disrespected, we know that price would most likely want to go higher. Now, why is this important? Because this we can use as another confluence, right? Once this candle disrespects this fair value gap, see how this second candle came down and filled this gap, right? Right? See this wick right here? Came down, touched this gap, and went up, right? This is called an inverse fair value gap because it was inverse, which means that this bearish fair value gap is now a bullish confluence, and price came down to fill in this gap and head higher. Now let's look at another example, but this time we will look at a bullish fair value gap being disrespected. Now, right here, right? Fair value gap is a 3 consecutive candle pattern drawn from a wick to a wick, and if there's no wick, you draw it from the body, right? Take a look right here. This would be an inverse fair value gap roll. Now we would ask why? Because this bullish candle right here was disrespected by this bearish candle. Now, how would we use this, right? So if we take a look at this, we can see that price came in and filled this inverse fair value gap, right? Would be like, oh, but JC, look, this candle is outside of this inverse fair value. Well, let me tell you, it doesn't matter as long as the candle body closes inside or outside of the fair value gap, right? So if this is now a bullish confluence, we want this candle to close inside or under the inverse fair value gap, right? If it was a huge wick up, but it closes inside, this is still a valid inverse fair value gap. So as we can see, this bullish fair value gap got disrespected, meaning that this is now a bearish confluence. We want to see price head lower, right? So if we take a look, price disrespected it with this bearish candle. This becomes now an inverse fair value gap, and you can see that price came up to fill this gap, and it headed lower, right? And that is the key concept of fair value gap. Remember, fair value gaps are a 3-pattern candlestick drawn from wick to wick, right? And it's extended across, and is a gap in price that price needs to fill again, right? We also need to note that in a bullish fair value gap, such as this, we want to know that it is the more lower, if let's say we're looking for bullish or bonds, right? The lower the bullish fair value gaps are, the more powerful they are. And if we're looking for bearish, the higher fair value gaps they are, the more powerful they are, right? This would be one more example. This would be a fair value gap. See, price respects it only by having their candle body close inside and then head lower. Now, how do we pair this, let's say, with the breaker structure fair value gap, right? That we learned from the previous video. Well, let's take a look, right? So, let's find an example right here. If you remember and you practice a break of structure, you would know that this right here is the break of structure, right? So we are from downtrend, and now we're in uptrend, right? Uptrend. And then if we were to mark out our fair value gaps, we will see that this right here is a nice fair value gap, right? This fair value gap from this low to this high is, we can estimate, around like 50% and lower, right? Which means that this is an efficient fair value gap. Now, when a fair value gap is paired with a break of structure, right? They both have to be either bullish or bearish, right? So we have here a bullish break of structure, meaning that we know that price is getting higher. Now we also see that price made a bullish fair value gap because the candle in the 3 consecutive candles are bullish, meaning this is considered a bullish fair value gap. Now, a fair value gap paired with a break of structure is almost enough confluence to give us a somewhat decent trade, right? So we see here, price does a break of structure, creates a big move with a gap in price, known as the fair value gap. And price came down, reacted, price came down, and reacted higher, right? This would be a bullish example of how to use a break of structure and fair value gap, right? Now let's take a look at a bearish fair value gap, right? Let's take a look at right here, right? We move this great uptrend here, right? So we're technically in an uptrend, right? And see how, if we were to know, this break of structure would be right here. Remember, this wick would not be the break of structure. You may ask why. It's because the candle closure never closed below this wick, right? Meaning that our break of structure would be this candle right here because it closed below. Now that we have a bearish break of structure, we can see that we would want a bearish fair value gap, right? Right here, wick till wick, and we see, if you drag along, price reacts and heads lower. Now, why would this also be an amazing trade? This is a trade that I took on Friday, February 9th. As you can see here, this is also a bearish fair value gap, right? Wick to wick, made from a bullish fair value gap. And if we drag it along, it becomes a bearish inverse fair value gap, right? And you're gonna ask why again? Remember, because price came down and closed below a bullish fair value gap, meaning that this got disrespected, and this is now a bearish confluence. Now, when we have this break of structure, which is bearish, with a bearish fair value gap and a bearish inverse fair value gap, we can see that price came up, right? wicked inside, so price came inside and filled these gaps and headed lower, right? So what I want you guys to do is to go on your trading view chart, right? Find bullish, bearish for value gaps, understand which ones got respected, which ones got disrespected. Try and find maybe a trade or two. You can find trade or two with a break structure fair value gap or an inverse fair value gap. You can, if you have any questions, you can take a screenshot of what you believe is a break structure fair value gap and send it into Discord, and I'll take a look at it. But that is your homework. I want you to find 3 bullish fair value gaps, 3 bearish fair value gaps, and 1 trade that consists of a breaker structure and a fair value.